Hello students, welcome to Accounting Explained at AccountWise Academy. This is Lata Venkateshwaran. This is the part 3 video of NCERT Chapter 2 11th Standard Accountancy portion. The chapter name is Theory Base of Accounting. I have explained this in a very simplified way and with lot of examples so that you can understand the lesson very easily. If you want to look into the important questions and MCQs of this chapter, you can see the shorts in our channel Accounting Explained at AccountWise Academy. I will be sharing part 1 and part 2 videos of this chapter Theory Base of Accounting. Today we are going to cover systems of accounting. Under systems of accounting we are going to see about double entry and the single entry. Next we are going to cover basis of accounting and accounting standards for today's video. Systems of accounting. Under that we are going to first see double entry. The advantage of using double entry is it is complete and reliable. Records both sides of a transaction, that is giving and receiving, minimizing errors and fraud. Using double entry it is helpful to minimize the errors and fraud. And it follows dual aspect principle, that is every transaction affects two accounts, debit and credit, ensuring balance. This I will explain with an example and we will take the same tea shop example as we had taken in the past two videos. Okay, suppose you are going to sell tea, each cup of tea for rupees 25. Okay, this involves two concepts. What is that? Your cash balance will increase. When you make sales of one cup of tea, your cash balance will increase by rupees 25. That is the debit. Okay, so debit. And your sales income will also increase by 25. That is credit. So in double entry we are going to take both debit and credit into account. Okay, and this double entry is suitable for all companies, being it a big company or a small company, because it is very accurate and complete. Under systems of accounting, next we are going to see is single entry. Single entry is incomplete and unreliable, does not capture both sides of every transaction, making reports less accurate. So in the previous example, what did we see? We are selling each cup of tea for 25 rupees and it has two effects. First, our cash will be increased by 25. So that is our debit, and our income has increased by rupees 25 and that is our credit. When you follow single entry, you may have only recorded cash and you may not have recorded income increase. So only debit you have increased. So this becomes single entry. Okay, this you have forgotten, you may have forgotten, or you may have totally avoided to increase the income. Okay. Limited information primarily uses personal accounts and cash book, lacking complete picture. So you have increased only the cash and you have avoided or you have forgotten or you did not know that you have to increase income also. So you cannot have the complete picture of your tea shop. See, you can calculate profit only when you have your income properly, and from that you can deduct expenses so that we can know about profit or loss of your shop. If you have not recorded income at all, then you will not be able to know profit or loss, right? So you will not have a complete picture of your shop. Again, advantage we can say is it is simple and flexible. Single entry is simple and flexible. It is preferred by small businesses due to its ease of use but lacks standardization. So, when you follow single entry, it is okay for tea shop, but when you go for bigger companies like computer manufacturing company or any big organization like car manufacturing company, you cannot follow single entry. You have to follow only double entry system of accounting because it does not follow any standardization. It is not standardized. See, with only increase in cash, you will not be able to calculate profit. Correct? So, it is not easy for bigger companies to follow single entry, or it is not right to follow. Okay? Choosing the right system, see here, depends on your business size and data needs. Double entry offers more accuracy and control. So with double entry, you'll have more accurate accounts and control over your accounts. While single entry might be simpler for smaller operations. Basis of accounting. So for basis of accounting, the most important thing is timing. Accounting method differs based on when they recognize revenue and expenses, like cash received or cash paid. When you are going to recognize your revenue when the cash received or cash paid, it is called as cash basis. Or when incurred or earned, when you are going to recognize revenue and expenses when incurred or earned, then it's called as accrual basis. What is cash basis? Cash basis is simple, but it's inaccurate and limited. It records income or expenses only when cash flows, leading to mismatched profits and violating the matching principle. So when you sell cup of tea that is rupees 25 on cash only, it is recorded. When you are going to sell on credit to some customers, then it is not at all recorded. That is called as cash basis. See, cash basis is easier, but profit picture may not be correct, as debts and income are not tracked properly because credit purchase and sales are not recorded. Next, accrual basis. It is more complex, but it is accurate. Recognizes income when earned and expenses when incurred, regardless of cash flow, providing a clearer picture of profitability. So this 25 rupees tea, it is recorded whether you are selling in for cash or when you are selling on credit. Both cash or credit, it is recorded. Similarly, when you are going to buy tea leaves also, whether you buy on cash or credit, when you record your accounting on accrual basis, it is recorded. Okay, so this accrual basis gives a clearer view of profitability and it tracks correctly outstanding debts and outstanding income, but it requires more record keeping because it takes into account both cash and credit. Okay, now how do we classify or how do we select whether we have to follow cash basis of accounting or accrual basis of accounting? When you are a small shop, so this tea shop also, it's a very small shop. If you are not going to sell on credit, you can follow cash basis. Okay, but when the shops, when they are going to sell on credit or when they are going to buy on credit, purchases to be made on credit, then it is good to go for accrual basis of accounting. Under basis of accounting, we are going to see next is matching principle. Accrual basis aligns with by matching expenses incurred to generate revenue in the same period, leading to more accurate reflection of performance. See, you are buying tea, that is an expense, right? This month for upcoming tea sales, that is the income. Accrual basis records this expense in the same month. Even if you have not sold all the tea yet, because then only we can have a clearer picture of your profit. Okay, see, more accurate reflection of performance is clearer picture of your profit. Okay, next, choosing the method. Accrual basis is generally preferred for businesses due to its accuracy. See, it records income. Accrual basis, when you follow on accrual basis, it records income when you sell tea even on credit. It records on accrual basis. Okay, like tracking all your tea sales this month. Records tea expenses when you buy on credit also. Like tracking all your tea purchases this month. This helps you understand your true profit for the month, considering both sales and tea purchased. Okay, but cash basis might be simpler for small entities. What does cash basis do? It is simpler, but it records only when the customer pays cash, like tracking only the cash receipt from cash sales, that is tea sales this month. Only cash sales it takes into account. Records tea expense only when you pay the supplier. When you follow cash basis, it records only when you pay a supplier, like tracking only the cash paid for tea this month. So following cash basis might be initially easy, but it does not give a complete picture of your profit, especially if you have credit sales or purchases. Okay, remember, understanding these contrasting methods. What is that? Cash basis and accrual basis, both are very contrasting, is crucial for accurately assessing a company's financial performance and making informed decisions. Next, we are going to see about accounting standards. Let's see about the features of accounting standards. First is uniformity for comparability. Accounting standards set common rules for financial reporting, ensuring consistent and comparable data across companies. So, common rules are followed for financial reporting where it will be consistent and easily comparable with data across companies, that is similar companies. Okay, credibility and reliability. By following these standards, financial statements become more trustworthy and believable for users. So it is more trustworthy and users will believe the data as the accounting standards are standardized. Okay, next is reduced ambiguity. Standards minimize alternative accounting treatments. There are no alternative accounting treatments. Even if it is available, it is only couple of alternative accounting treatments when we follow the accounting standards, offering clear guidelines for valuation and disclosure. So we can see about the valuation of stock, for example, clearly how they have valued the stock, and disclosure also will be clear. We can easily find out from the financial statements when accounting standards are followed correctly. Enhanced decision making. So how your decision making will be made? Users like investors and creditors can confidently compare companies' performance based on standardized data. So there will be standardized data, that is data across companies, similar companies. So investors and creditors can compare our company with the similar companies which is in the same line, and they can confidently have a good picture of our company for their decision making. Okay, true and fair view. Standardizing practices contributes to presenting a more accurate and realistic picture of company's financial health. So the standardizing practices is there, no, accounting standards. It gives us a more accurate and a realistic picture of what? Of our company's financial health. Benefits of accounting standards. Uniformity. It eliminates variations in accounting practices, leading to comparable financial statements across companies. So take for example, there are two companies A and B, both are shoe manufacturing company. Okay, So they are in the same line of business. A follows cash basis, assuming, and B follows accrual basis of accounting. So there are variations in accounting practices, but we have a comparable financial statements across companies, that is A and B. Okay. Next is transparency. Encourages disclosure of useful information. What is the disclosure of useful information here? That A follows cash basis, that is disclosed, and B follows accrual basis, that is also disclosed. This is beyond legal requirements. Who are all the benefiting users here? Investors and the creditors. Okay, comparability enables meaningful comparison. What is a meaningful comparison we can make? Like which company is generating more profit, A or B, managing debt better, A or B, or has a stronger overall financial position, A or B. So these are all the meaningful comparisons between companies, that is between A and B, within the company, or within A or within B, same company over time for year, quarterly, half yearly, like that. Okay. So in essence, we can say uniformity, transparency, and comparability are the essential building blocks of reliable and informative financial reporting. They all work together. These three, they all work together to provide a clear picture of company's financial health, allowing investors and creditors to make sound investment and lending decisions. Limitations of accounting standards. Limited flexibility can restrict the choice of appropriate accounting treatment in specific situations. Okay, so we are going to take example of car manufacturing company. Accounting standards, how it affects a car manufacturing company. Okay, take for example R&D expense which has been spent by the car manufacturing company to create new models of car. Suppose it had spent 5 lakh rupees on R&D, and if the R&D is developed indigenously, accounting standard says that this expense can be spread for 5 years and each year 1 lakh can be deducted from our income. Okay, suppose, see, it takes a lot of time to develop a new model of car. Suppose we are going to develop new model car only in the 7th year. Okay, and our car became hit only in the 8th year. What happened? Initial in the 5 years, our profit was decreased by 1 lakh rupees, which is not correct. Actually, we have reaped the benefit only in the 8th year. So it is not showing properly. Can restrict the choice of appropriate accounting treatment in specific situation. This is one of the specific situation. Okay. Rigidity may lack flexibility in specific cases, potentially hindering practical application. Suppose if our company, car manufacturing company, has inventory of cars. Okay. So this is a rapid changing technology nowadays we are in. So it might say to depreciate or value car each year in a specific manner, but new models of car are coming every year. New models are coming, or every half yearly new models of car are coming to cater to the needs of the customers. So this particular method of valuing inventory may not be correct when the technology is changing very fast. Okay. Legal boundaries cannot override existing laws and regulations, requiring adjustments within legal framework. Nowadays we have got lot of choice as a customer, whether to lease or buy. And as a customer, even your parents would have leased only cars. They would not have bought the car. So no one is going to go to a car showroom with hot cash and buy car. We are going to only lease the car. Mostly leasing is the main option. But accounting standards does not give proper laws and regulations for leasing. Okay. So that has to be properly done. So these are the limitations of accounting standards. Remember, while accounting standards offer significant benefits, the benefits outweigh the limitations for sure. By promoting uniformity and transparency, it's essential to acknowledge their limitations. So the limitations should be acknowledged because the technology is changing very fast, and it should also be, accounting should also, standard should also be flexible and not rigid according to the new technology changes, okay, and ensure their application adapts to specific circumstances while adhering to legal requirements. Like these are some of the exceptions we saw, no? These are the specific circumstances which has to be even taken into account. Okay. So this is a part 3 video of chapter 2. With this, we are finishing today's video. Do like our video and share it with your friends if you find it helpful. Subscribe to our channel, which will encourage us to make more videos like this one. If you would like to inquire about the accountancy classes which I take, or to get more worksheets for problems with solutions, contact us at acct.wiseacademy@gmail.com. Thank you for watching.